Welcome back to REIQA.com Real Estate Education Program. Be sure you started with the welcome video and have already completed sections 1 through 10. In section 11, we will cover about buying and selling notes. Please subscribe to our channel, like this video, and ask any follow-up questions in the group. Our experienced investors will respond throughout their days to help you. Check out our website at REIQA.com and the links in the description below for more real estate help, tools, and resources. Now, let's begin section 11. In section 10, we covered using seller financing as an exit strategy, or doing what a bank does. Once you get into seller financing, you may also decide to expand into buying and selling notes. This is the next step the banks take as well. Many small or regional banks do not keep 30-year mortgages on their books. They sell the paper to larger national banks or to Fannie Mae and Freddie Mac, who securitize residential mortgages and sell them to investors as mortgage-backed securities on Wall Street. You can also sell your seller finance notes or buy other people's notes as long as they're set up correct. There's many private investors and investment firms who invest only in notes and not actual real estate itself. First off, what is a note exactly? A note is the security document tied to any loan. This could be a mortgage note, promissory note, etc. There are secure notes and unsecure notes. Although when dealing with real estate notes, they're all typically secure notes secured by the property. So, why would someone sell their note? Capital needs. Maybe you're in the capital ramping phase where you need capital more than you need cash flow. So, you try to flip a property and are having a hard time selling for cash. Well, you can always sell the property on terms or seller finance it to a buyer, collect a good down payment, then sell the note to a note investor, so you can go ahead and cash out on it and free up the capital you need to do the next deal. Another scenario would be if you have a lot of notes established and find a large project or apartment complex that you need to raise a lot of capital quick. You can sell a portfolio of notes and have the capital for that major project. Also, once you're established, you can even pledge a group of notes as collateral for a loan from a bank or credit union. There are two different classifications of notes, performing and non-performing. Performing notes are notes where the borrower has paid a minimum number of payments, called a seasoning period, typically 6 or more months of payments, without missing any payments and are still current. Even with performing notes, most note buyers will expect a discounted price off current principal balance, but some private buyers will pay full principal value, especially once you establish your name and reputation for having good notes with all the correct paperwork and good paying borrowers. It's pretty easy to find buyers who will pay 80 to 95% of current principal balance to purchase performing notes. Non-performing notes are notes where the borrower has fallen behind in excess of 90 days. These are bought and sold at substantially discounted prices. Investors buy these and first try to get the borrowers to pay up and get them current, or if not, they'll foreclose on them and take the property. There are even online sites where you can buy and sell notes. With non-performing notes, they're typically discounted anywhere from 50 to 80% off current principal balance. So, you may be able to purchase a $100,000 note on a property worth even more, for as little as $20,000 to $50,000 depending on how far behind the borrowers are, which would definitely be worth the time and expense to go through collections and potentially have to go through full foreclosure. There are also what's known as first and second lien positions, meaning some properties will have more than one loan, such as a HELOC, home equity line of credit, or other second position note. So, that all goes into pricing the value of a loan as well. In the event of default on payments, the first position has the first rights to the property, so those will always be more valuable. But there are note buyers who will buy second positions as well, usually because they think they can let the first position holder do all the work, and they still have rights to their portion at a payoff point. Also, you can sell partial notes. This is something very advanced seller financiers do. For example, say it's a 20-year loan, while maybe you only sell 5 years worth of payments or 10 years, etc. Then you still own the back end of the note, which, as we all know about mortgage loans, the front end is interest heavy. So on a 20-year note, after 10 years, there's still a significant principal balance. You can see how selling only part of a note would work out well in your favor. For example, with a 20-year note that has an initial loan balance of $50,000 at 10% APR, 10 years payments would be right at $58,000. Let's say you sold those 120 payments for $40,000. It's a good deal for the buyer in comparison to what they are getting investing in the market, but you would still own the back half, or the last 120 payments, and after the 10 years, the borrower would still owe you over $36,000, and you would collect payments for the next 10 years. You would still have your position in the event of a foreclosure, or if the borrower paid off the note early, you get paid. That concludes this section. In the next section, we will discuss the BRRRR strategy, also known as buy, rehab, rent, refinance, and repeat. Please subscribe to our channel, like the video, and ask any follow-up questions in the group. Our experienced investors will respond throughout their days to help you. Check out our website at REIQA.com and the links in the description below for more real estate help, tools, and resources.